Good morning and welcome to MarketCast 24. That's 2 years worth of insight, information and crazy shirts. I hope you like the offering this morning. It is, when all's said and done, the season of mists and mellow fruitfulness, and as the sun just about breaks through a grey sky here in Bournemouth at the AF Oliver offices here in Bournemouth, we're going to try and deliver you 30 minutes on how the market is and where the market's heading. And while we're on the subject of weather, well, we've got a new government now, haven't we? We took August off. We let you take August off, we took August off, and since that time, we've had 3 months of the new administration, and they've painted a picture for us of absolute doom and gloom ever since they took office. So I felt that this was quite a nice little preface really to what this morning's presentation is going to cover: Labour's sunny uplands. Keir and co really have taken us to the edge of despair with their message, their continual and repeated message of doom, gloom and more doom. And I love this. It's basically, it's bad news, it's dreadful news, and even ineffable news as the whole their scheme goes on and on and on. And finally, that results in a plunge in the GfK consumer confidence measure. And guess what? Last week, we've had the Labour Party conference, and suddenly they've sat round in a back room somewhere, haven't they? And someone has said to somebody else, do you know what? I think we've possibly overcooked this. Preparing everybody for the worst so you can deliver them something that's a little bit better than the worst is all well and good. But if in the end you push the entire population down into their bomb-proof bunkers in the back garden, that actually does nobody any good whatsoever. So there has been a noted and an evident change in style and in message as they now talk about a little bit of hard work to do, but better things around the corner. We'll come back to the confidence barometer in a moment or two, because history has proven what a great predictor that is of house buying behaviour in the 3 months that follow the current month's reading. So that will give us a really good short-term indication of how things are going to move. Normally, personally, I think that this particular month is a real reaction to the news that they've been given, and it won't necessarily, for me, that doesn't necessarily paint a dip in the market. We'll come back to that in a moment or two. Also, we've had inflation sticking at 2.2%. We'll touch on inflation, where that's gone. And that meant that despite a 50-point reduction in the interest rate in the States, the Fed, the Federal Reserve, cut the rate by 50 basis points. At the last meeting of the MPC, there was no movement, and we are stuck at 5%. I am absolutely certain that we will see a minimum of 1 and possibly 2 interest rate cuts before we see the year out. There are only 2 more meetings left this year, and I think there's a chance that we might see a cut in both of them. That inflation number is really important, and it is sticky. More detail on that as well to follow. All of the key indices that and I'll show you them, we'll run through them at pace. The whole thing about having the indices here really is just to provide a little bit of backstory to some of the things that we're talking about as we run through this 30 minutes, but there is not enough time on a market cast to go into detail on every single index that's out there, but they are all showing surprisingly good numbers. So for those of you that remember me wheeling out Duplo, the Diplodocus, over the last couple of months, well, he's got a little bit of a hump in his back, if I'm going to be quite honest. The market has been better this summer than I was expecting. Not necessarily in volume terms, however. Rightmove May Index suggests that finally, there is a little bit of movement in terms of asking prices, but seller sentiment is still good. And that's if Rightmove is still about in a few months' time. We're, I think, 3rd bid now from Rupert Murdoch's media group coming in for Rightmove, and that could turn into a battle. So that would be a really interesting one to watch, because we all know how popular Rightmove is on here, don't we? Okay, let's have a little look at what the press are saying right now. And, well, you can't move for stories about first-time buyers. Clearly, there has been a little bit of data that's come up saying first-time buyers are getting active and back in the market. And quite honestly, wherever you go right now, the stories are out there. Here we go. This is the Times here saying the market bounces back as first-time buyers return. We will all be sitting here as we go into quarter 4 thinking about how Q4 was in 2023, and that was dire, an incredibly difficult last quarter to finish this year. This year looks like different gravy to me. And you can see here, this is the story on the Times, in the Times, talking about FTBs coming back. And look at this. This is the Guardian talking about FTBs in London. And they reckon that FTBs, first-time buyers, have made up almost half of all the house buyers in London this year, according to the data, probably looking at the same data and slicing and dicing it slightly differently. And look at this here. This is Forbes advisor talking about the mortgage deals that are out there right now. And these are the building societies chasing down the first-time buyers. Indeed, the building societies are chasing down just about everybody right now. Here's the Guardian, not normally one to be talking the market up unnecessarily. Housing market at its strongest since Truss's mini budget. Remember that? the Truss Quarteng magnum opus. And it's the strongest it's been since there. And this is an interesting one that I pulled up off the BBC website just yesterday, actually, because they mention fear of missing out. And I raised this. If you go back and have a look at the July MarketCast, I said that this was an issue for us because clearly we are going to see rates fall over the next 6 months unless something completely unexpected happens. And given the volatile geopolitical situation that we've got going on around the world right now, never rule anything out. But all things being equal, it is virtually certain that we will see rates come down over the next 6 months. Now, there is no question that the building societies are chasing those rates down. We've just had Barclays announce a 5-year fix, 60% loan to value at 3.74%, and 3.71%, 3.7% for their existing premium customers. And that was hot on the heels of Nationwide, who earlier this week announced a 3.74% on a 5-year fix. They are chasing each other down as they're trying to find business on a reduced volume. We are probably going to end up the year about 1.1 million transactions, but nevertheless, these guys need this business and they are looking further forward and seeing that the writing's on the wall in terms of lower interest rates being led in the US, obviously. So this fear of missing out, if I buy my new home today and I know that rates are going to fall in 6 months, why on earth would I be taking on a 2-year or more significantly a 5-year fixed rate when I know that rates are coming down? For all the developers that are watching this MarketCast, that's something that we need to bear in mind, and we need to be future-proofing purchasers. And the same applies when we think about the budget as well. Let's have a little look. We'll talk about key dates and we'll talk about the budget in a moment or so, but we've just had the conference, the Labour Party conference, and I've followed every word of that, particularly Rachel Reeves and particularly Keir Starmer, to see if there were going to be any clues in there about the way that Labour policy was going to affect the housing market over the next 6 to 12 months, and I could find nothing. We talked about the overhaul of the planning system. Well, heavens, we all know that that is long overdue. Mandatory targets coming back. The grey belt, so areas of the green belt becoming grey belt, and the right to buy, of course, which was something that the Labour Party were talking about in the run-up to the election and are determined to deliver. And on top of that, of course, we've got the golden passports for brownfield development that Labour are talking about. Lots of things designed to try and get the industry moving. They are saying that they are going to deliver 1.5 million new units in the lifetime of this Parliament. I would be amazed if they do that. In fact, if they do, I will send Keir one of my shirts, one of my MarketCast shirts. I can't see it happening, quite honestly. And I'd be very interested. I'm speaking at the HMIC next week, and I'd be very interested to see how many people in the audience there think that we're going to be able to deliver 1.5 million homes over the next 5 years. Can't see it somehow. Here are the key dates that we need to be thinking about then. So inflation numbers come out halfway through next month, the 16th. And then, of course, that is going to feed into everything. Whether or not that will be in time to affect what Rachel Reeves says in the budget, who knows? But that inflation number is really important for us. We'll touch on inflation in a minute or two. And then the next MPC meeting is on November the 7th. Just after fireworks night. Whether it will be fireworks on the 5th and then fireworks on the 7th, I don't know. But I am putting my money on a minimum of 25% basis points reduction on November the 7th. Yep, I'm pinning my colours to that particular mast. And look, they're pretty bright colours too. So that's the 7th. I'm even thinking we might see a reduction on 7th and in December, which I think is about the 12th. So then, of course, we've got the big one. And for me, when I'm looking forward now about what the market is going to do next year, and over the past couple of weeks, events that I've been to and I've attended with developers, and they say to me, what's the market going to do in 2025? It really is almost impossible to call until we've been given some idea of what the government intends to do in terms of the aspects that affect the home buying process. Stamp duty will come. I'll talk about stamp duty in a bit more detail in a moment, but stamp duty on the basis that the Labour Party have stated categorically they do not intend to raise income tax, they do not intend to raise VAT, they do not intend to raise national insurance. Where is the money going to come from? It has to come from somewhere. So is it going to be messing with the stamp duty? And don't forget stamp duty, we've still got that loaded bomb coming up, because in March, the current allowance on stamp duty, which sits at the moment as the first £250,000 is stamp duty free, March 2025, that gets halved. And if you don't think that your prospective buyers aren't aware of that right now, then think again. I'll show you why in a minute or two and show you how changes in stamp duty massively affect the volume in the market and when people buy to try and avoid one of the most hated taxes in this country. Capital gains tax, wealth tax, who knows where Rachel Reeves is going to turn to find that the 22 billion to fill that black hole on the basis that none of the mainstream taxes for working people will be raised. So that's a really important date. I'm sure we'll all be watching that with great interest. And in terms then of where the market is, they're the dates that we're looking out for. In terms of where the market is going and where it's been, let's first of all just have a quick look at stamp duty and how it affects things. This little chart here are volumes, and they are volumes that actually go back there to 2014. So 2014 to 2019, we're all agreed, was that extraordinary period of 5 years of calm in the housing market, 1.2 million transactions a year, regular as clockwork. You could almost set your alarm by it, and it came along there beautifully. And then suddenly we get this spike going on here. Here's a bit of COVID lockdown, a bit more COVID lockdown, so that obviously produces a spike. And then look at this. Why are those spikes there? Well, let me show you. Here we go. This one up here was when they started applying stamp duty and land tax, that additional 3% on second homes and investment properties. So this is where it came in. Look at the spike that created. You had about 4 months transactions all taking place within 1 month to create that spike, just to avoid that tax. I remember back at the time that we were looking at it, I was in housing market reports, and I was saying that the money these people saved on the 3%, they lost in having to overpay in the rush for properties. Absolutely crazy, but true. That's what people will do to avoid paying stamp duty. And then have a look at this. So this dip here, of course, is the lockdown. And then suddenly there's a stamp duty holiday because the economy had crashed because of the lockdown in early 2020. Stamp duty holiday, and look what goes on here as a stamp duty holiday. So this is where the stamp duty holiday ends. That spike is absolutely beyond belief. People were scrambling over each other, trying to get deals completed. Do you remember? And of course, in the event, the system creaked and broke. So what did they do? They started a second stamp duty holiday. They extended it. Do you remember this happening? And that's the end of the second one. So all of these spikes, there you've got there 10 years worth of property transactions. And all of the spikes involved in those property transactions are all related to changes in stamp duty. So if you don't think that stamp duty dramatically affects buyer behaviour, think again. And you've got a big change coming up in March. So we need to be thinking about that, and potentially we've got a big change coming up on October the 30th as well, when Rachel Reeves announces her budget. Just wanted to put that chart in there. I thought that was worth doing. Let's have a little look This is a disaster zone at the moment right now. So the latest consumer confidence data, this was collected it was collected between August the 30th and September the 13th. So this data in here is about 10 days, 2 weeks old. And you can see what's happened. All of these gains that have been built up over the past year to 18 months, lost in 1 month, which I am firmly convinced is a result of being told over and over and over again, the National Health Service is broken, the finances are shot, there's a huge black hole, everybody's going to have to pay more, it's all going to be terrible, much worse than you thought. And the result here is evident. And what I think is really interesting in these numbers, those of you who've seen this before, my apologies, a really brief run through to say what these things mean. The red line here is the overall index score, of course. The blue line here is how people feel the UK economy is going to do. And you can see where that dived there. That is a record 1 month fall there, by the way. The green line here, is it a good time or a bad time to make a major purchase? And again, a huge, almost record-breaking fall. Don't forget that everything below this yellow line here means the majority of answers were people saying, I think things are going to get worse, not better. So that's that fall there. Really importantly, this line at the top here, in other words, how are your personal finances going to fare over the next 12 months? Are they going to get better or are they going to get worse? We finally, back in March, we finally broke into positive territory for the first time in years, and up we came. People were feeling better off. They felt that they were going to do better. And then suddenly you can see from August into September, brand new numbers, it's fallen back into negative. And here's the thing. These numbers, these GfK numbers, which if you've watched MarketCast before, you'll know have been about for over 50 years, are all over the media this week. You can't pick up a newspaper, listen to the radio, or even on the television. Everyone is talking about them because the fall in that month is so dramatic. And I am quite certain that Keir and the team will have been briefed on that when they all sat down together at the Labour Party conference, hence the change in language and tone. But that's a concern. The point I was making, poorly making, I might add, at the start of MarketCast today, was that I don't, normally, I add this into my equation about how people are feeling and where the market's going to go. I'm not going to adopt that 1 month fall. For one thing, 1 month does not represent a trend. It generally tends to represent a dip. And I think there is a really good reason for that. People reacting to the first 3 months of the new government, and I think we might see that reverse next month. So I don't necessarily think that that means we're suddenly going to see a plunge in the housing market. I still see that steadily moving on up Diplo's tail. Diplo the dinosaur, that is, tail. My beautiful chart, this is the Property Mark data that's collected from all the members of Property Mark, which I then put back into the lovely colour chart that they used to produce back in the day. And you can see here, blue on the chart, deals done above asking price. Orange on the chart, deals done at asking price. Grey, deals done discounted to asking price. You'll also notice now that the March-April 2022 has dropped off the far end of the chart, which is a real shame because it actually showed almost half of the deals being done in the UK being done above asking price. Crazy but true. And you can see here there has been this marked drop-off. These numbers are always a little bit out of date. So these are actually only July numbers. They're the latest ones that they've published, but they are only July numbers. They're, a month and a half ago. I just feel that's a bit of a reaction to a slight slowdown in volumes for summer. I don't read any great concerns into there, and I think that's more of a blip too. I think we'll see that coming back as we come back out and into the autumn market. These then, stripping all the colours away, there you go. They are the deals that have actually been done at or above asking. I like to think that this is not a downward trend. It's more of a blip for that month. It certainly makes me feel that way. So if we start then to look at where that leaves the key elements that affect the decision-making process, This was a year ago, that's September 2023. Have a little look. So just see where these things are, the changes in stamp duty and so on, and look where lifestyle changes were and the employment market. And this is where we've moved to from there. And you can see there that there is really quite a big change. Stamp duty suddenly moves up in importance. People are talking about it all over the place. That does now matter. People are actually building that into their decision-making process. You can see here that high mortgage rates now are moving back in terms of impact. They're getting better. Consumer confidence has moved down in that equation. We'll see where that goes next month. That could be temporary. But general inflation has moved back as that falls and stays. Lifestyle changes right out here. And the hot employment market has cooled down considerably. That's what's feeding into my thinking about what's going to happen in the market next. A quick run through the indices in the last 10 minutes then. This is the right move here, 0.8% increase in September. High seller sentiment there, that's about double the normal interest from August into September. Quite extraordinary. So the average asking price now over the year, 1.2% up. I don't think that's a million miles away from where we thought it was going to be. I put these charts on here not to take you through them, to give you a sense of trend. This is the average asking price trend, and you can see where we've been. There's definitely a bit of a dinosaur shape. I heard you say that. Dinosaur shape. Yeah, you're absolutely right. Nationwide, always a tricky one to do nationwide, because we do this market cast towards the end of the month. We are looking at old data. So this is the August nationwide data. Their new data comes out in a few days' time. But nevertheless, who would have thought if we look back at this time last year that nationwide would be showing almost 2.5% increase over the 12 months. Very, very few of us. I was predicting that we'd be flat around about now, and you can see that we are 2.5% into growth. So extraordinary. Oh, let me pop back one moment. I have a quick word about that in a moment or two, by the way. The effect of EPCs, energy performance certificates, on prices. Nationwide, 3 months on 3 months, excuse me, probably my favourite measure. And you can see there that we've got that. We've had our little summer dip early. We're building out much more quickly out of that summer dip. And I think we're in for a pretty positive autumn. Very quickly on energy efficiency, I won't talk you through these in detail. Nip online and have a quick look at this month's nationwide report, because this is all in here. But this shows you how selling prices, are affected by EPCs. So if you're in an A or a B EPC, all new homes or virtually all new homes, talking about almost 3% price premium over the average. So they take their average in here at C, and you can see that for the AB, that gives you a 3% price premium, and F and G, some of the bigger old drum second-hand properties, over 4% price disadvantage by having that low EPC. This chart over here shows how attitudes are changing. So there's our 2.8% for A and B advantage over the mean, over the average. Look at this. In 2019, it was 1.7%. It's almost doubled that price differential during that time. It's only going to get bigger, isn't it? And it's not just the money. It's not just the money. It's the fact that people are doing the right thing and they're helping the environment. That's all so important too. Really important for us in the new homes industry, that's for sure. The Halifax Index, well, showing pretty much what the other indices are too, but they've got their annual change up at 4%. Zoopla, with their unique algorithm where they blend asking prices and they blend selling prices, and you can see that they've got the market almost exactly flat. Good old Zoopla. That's what I said it was going to be last December, 0.5%. Homes per sale per estate agent, sitting at 33. That is a 7-year high, by the way. So we've got proper stock back out in the market, which can only be a good thing in terms of market liquidity. And you can see here how much longer to sell a home if the asking price has to be cut by 5% or more. 2.5 times longer. So the price that the property is set at when it goes on the market is absolutely crucial in terms of how long it takes to sell the property. When you think the process through, it sounds a bit obvious really, but it's such an important thing, certainly for the agents to be taking note of here. Buyer demand 20% up, sales agreed 23% up. This is on a year ago, by the way. Flow of new supply 12% up, stock of homes for sale 14% up. All in all, a very, very positive picture. And you can see here, these are sellers that have had to take a hit of 5% or more, and that big climb has dropped away now and is starting to even out, which reflects the improvements in the market that we've seen since the last quarter of last year. Really interesting data from Zoopla, well worth taking a look at if you get the chance. Mortgage approvals still running only just over 60,000, which generally tends to give us around 90 to 95,000 in terms of residential transactions a month, but we will hit in between 1 and 1.1 million transactions for the year, something that we predicted literally back last December, and that needle has virtually not shifted the entire year. Inflation, well, it's stuck now, isn't it? At 2.2% for CPI, 3.1% for CPIH, that's the home owner cost in there. This is the little monkey that's causing us all the trouble here. The owner-occupier home costs here, which are up at 7.1% and continue to climb. So these are the costs associated with owning your own home, but taken out of there are things like energy, things like tobacco, things like alcohol, all of those things taken out of there. And you can see that those owner-occupier costs are continuing to climb. Hopefully, they're starting to come under control. You can see where mortgage rates trends have gone. I've spent a lot of time on this already. No more time required on that this morning. A brief 2 slides from the RICS. Their August survey. These are our very favourite pessimists, professional pessimists, of course. But have a look at what I call the canary slides, the warning of the canary down the coal mine. Look at this. These are new buyer inquiries by region over the previous month. So these were the July new buyer inquiries. Anything above the line means it's been an improvement. Anything below means it's been attrition. And you can see here, West Midlands aside, well, West Midlands and Scotland aside, you can see here pretty much across the piece there's been improvement. And if we look at new vendor instructions, people instructing to sell, again, we've got a steady line pretty much right the way through, and the attitude of the valuers and the agents is really good. And I've stuck these two here, these 2 slides on here side by side. These are sales expectations, the amount of properties that they believe are going to sell in the mauve line over the next 3 months, in the azure line over the next 12 months. Above the line means more, below the line means fewer. Look where that is now. Look where that is in positive territory, and think where it was just a short time ago. And this one here is whether they think the prices are going to go up or down. Even the 3-month measure here is well above that line into positive, and the 12-month, well, that's right up there. So that's how the valuers are feeling. That's how the agents are feeling. That's really important. Stocks now 7-year high, 62 according to Rightmove. Average stock per agent sitting there. So where does that mean we go then in the final quarter? Well, these are the actuals. This is where we are, including that August number, 2.4% for the nationwide, which was actually a small fall. There was a small fall in the average price from the nationwide, exactly as expected in August. But when you compare that against the previous year, it represents a 2.4% increase. I'm staying with my prediction that we're going to end the year flat, and that does mean I can bring Diplo on, not quite as far forward as he was before. And for me, it still works. We'll see whether that works out in quarter 4. I think what I'm trying to say is I think we will see that continuing flattening out of the average selling price over the last quarter. But when you compare that to last year, then we'll probably see that increase over the previous 12 months. It will be interesting. It won't be far out. I think what's most important is that when we look back on where we were at this time last year, and all the newspapers were full of words like plunge and plummet and disaster and catastrophe and crash. And we said back then that that just simply wasn't going to happen. And of course, we now can say in hindsight that it absolutely hasn't. So then in summary, as we just run over our 30 minutes, for which I apologise, October budget is going to have a big effect on Q4. I am not going to make the call on 2025 until I've seen what's in that budget. Right now, if you sort of pin me to the wall and say, come on, give me your thoughts, it's looking for all the world as though it's going to end up with a 4 or 5% inflation number. But I reserve judgment on that once I've heard what the financial planning is. Inflation, close to the government's target now, but we've got that sticky inflation in the middle of it. The Fed has cut its rates by 50 points. I am convinced we are going to see a cut in November. And I'm even 50-50 about a cut in December too, and that will have a big effect as well. So positive government strategy that we've seen has been evident since the Labour Party conference, and that should help that huge drop in consumer confidence. I think that will come back next month, we'll see. For me, the outlook for the autumn is generally a positive one. Real opportunity now. You've got a window now, haven't you, of about 6 weeks or 5 weeks to get in before the October budget and to actually give people some forward-looking assurance of how their situation is going to be post-budget. Because clearly, you've seen those consumer confidence numbers. Clearly, that is actually worrying people. There's some opportunities out there to offer guarantees of how things are going to be post-budget. Hopefully, I will see most of you at the Housing Market Intelligence Conference on October the 3rd. Looking forward to that. Our next MarketCast here live from Bournemouth is actually going to be on the 31st, Thursday the 31st of October, Halloween. So I will wear an appropriate shirt for that, obviously. And then in November, we've got a live MarketCast planned in London, and we'll be giving you all the opportunity to actually come and join us in the audience and then fire some questions afterwards and enjoy the show firsthand. Sorry for overrunning by a couple of minutes. Packed an awful lot in this morning. Have a great day and a great weekend to follow out of the rain, hopefully. And we will see you back here at the end of October.